Hello and welcome to The Money Show, your one-stop destination for all your personal finance queries. Today we have lined up a power-packed show for you, and here's what you should expect onto the show today. First up, with the continued outperformance in the broader markets, we will analyze that if this is the right time for you to book profits in the small cap space. For this, we'll be joined by Pankaj Murarka, who is the CIO at Renaissance Investment Managers. And next up to our second discussion, as monsoon havoc wreaks havoc across the country, we will discuss how you can save your car from the damage this monsoon. We will talk about the add-ons that you should consider to protect your car. We will be joined by Amjad Khan, Executive Director, Employee Benefits Practice and International Business at Anand Rathi Insurance Brokers. And finally, on our last leg, we'll throw upon the counter for you to get your mutual fund portfolio queries answered by Kaustubh, who is the Director of Fund Research at Morningstar Investment Advisors, India. So do send us your queries on our WhatsApp number, that is 865-797-4571, or you can also email us your queries on themoneyshow@etnow.tv. But before we begin our show, let's get you the top headlines of the hour. Nifty ends the day 0.5% up, but all eyes now on Fed's decision later tonight. A 25 basis point hike is expected even as inflation dips below market estimates. Bajaj Finance results in line with expectations, with AUM growing 32% YOY. Axis Bank profits jump 40% YOY. Sources say Qatar Investment Authority could pick up 1% stake in Reliance Retail for $1 billion. Reliance share upbeat. Next GST Council meets likely on August 2nd, says sources. A discussion on framework for 28% GST on online gaming is likely. Centre halts supply of rice for ethanol production days after it banned export of non-basmati rice. Distillers feel the heat even as sources say the move is temporary. Lok Sabha Speaker Om Birla admits no confidence motion moved by opposition against the Modi government. The government is unlikely to face any difficulty though. Hello and welcome. You're watching The Money Show with me, Shrishti Sharma. And first up, onto the discussion, we'll talk about the outperformance we have seen in the broader market space, and is this a time to book out profits, or you should continue to rally on? Because Indian equities markets have seen a bull run in the recent times, with benchmark indices hitting the fresh life highs. In fact, Nifty is on the verge of breaching that 20,000 mark, still some points away. But during this rally, if there's one space that has outpaced the benchmarks, it is definitely the small cap space. Now the big question is this a right time to book profits in small cap, or will the rally in the broader markets expected to sustain going ahead? Let's answer all of these questions with Pankaj Murarka, who is the CIO at Renaissance Investment Managers. Hi, very good evening, Pankaj. Thank you so much for your time to ET Now, and pleasure having you. Firstly, when we see the outperformance of the broader markets, how do you see this? Do you believe that the bull run of 2020 or 2021 post-COVID is once again back with the same feel? And how do you spot the broader market space? And along with that, is this a right time to book profits, or one should stay invested?
Well, good evening, Srishti. I think there are multiple questions in your one question, so let me address them one by one. I and we firmly believe that the bull market that started post-COVID, what you were referring to, is very much intact. What we had between November 21 and let's say March of this year was more of a consolidation in the long-term bull market, and the same bull market continues. And the fact remains that Indian economy is delivering pretty healthy growth, and the outlook continues to remain reasonably strong. despite headwinds and turmoil globally. So I think the bull market in equities is pretty much live and kicking to my view. And in that context, given the fact that earnings growth for corporate India and for Nifty companies has been reasonably strong, I'm not surprised that index has touched 20,000. So the broader outlook on the equities continues to remain positive. I don't think so. Well, yes, markets are at all-time high. But having said that, the fact is corporate profits are also at all-time high. Corporate profits are still growing at mid to high teens. So in that context, I think investors having a medium-term view, for them, the outlook on equities remains positive or constructive in that sense. And I don't think so there's any need or reason for investors to take money out of equity. Having said that, what I really feel somewhat concerned is about the move that we have had in the small caps. So I think that's one space where the move that we've seen in stock prices across small cap indices has been pretty sharp over the last few months. And I think it's not a bad idea to reallocate some money from small caps to large caps so as to reduce the risk of the portfolio in that sense. Because all of us know that when markets rise, small caps rise much more or much higher than large caps. But having said that, when markets correct, small caps also fall much more sharply than large caps. And there are pockets of small caps where we can see some froth as well in terms of valuations. So I think the overall bull market is very much intact, but it's not a bad idea to reallocate some money from small caps to large caps so as to reduce the risk of the portfolio.
Pankaj, totally take your point, but just wanting to get a sense on, at this point in time, how do you spot the pockets that look overvalued to you right now? Because if I see the Nifty small cap index, then a couple of sectors that have seen amazing moves in this 1 year or so is definitely the aviation, definitely the defense space, as well as the railway stocks. What's your view on specifically both of these sectors? Do you feel that given the valuations that these are trading in, they are somewhat stretched and a good time to book profits in this one?
So, well, medium term, longer term, we like both the spaces because there are very strong underlying growth tailwinds for both the sectors, both defense as well, because India is focusing now more and more on indigenization of our defense, which effectively means 80% of our defense goods were imported, and we want to reduce that dependence and manufacture more at home, which effectively means domestic companies and defense manufacturing will do well. And likewise, railways is on a mega investment cycle that we have not seen in the last 70 years in India. The magnitude of investments that the railways are going to make over the next 15 years will exceed the cumulative investment that we have made by railways in the last 75 years. So that puts things in context. Having said that, again, coming back to small caps per se, when we're looking at small caps, it's more stock specific than sector specific, because many times we see very divergent performance from two companies within the same sector as well when it comes to small caps, because these are small companies. So a small improvement can have significant positive benefit or impact on their operating numbers in terms of revenues and profits, and vice versa as well. So when it comes to small caps, one has to take a more stock specific view. And if you look at the aggregate small cap valuations, let's say when you refer to Nifty small cap index and so on, I think those valuations are now trading at the upper end of where they have in the last 15, 20 years. And mind you, while we remain positive on the market, the fact is this bull market is now matured bull market, because now we are in the fourth year of this bull market. So the general investment philosophy is, as you move towards deeper into the bull market, or as the bull market sustains longer, you keep cutting your small cap exposure and move that money to large caps so that you keep reducing your portfolio risk. Because the fact is, when markets fall, small caps will fall much, much more than the large cap indices.
Okay, Pankaj, though the long-term view on the Indian equities definitely remains to be positive, but in the near term, do you spot any headwinds for this up move? Do you believe that maybe the Fed decision or something else, because till now the corporate earnings haven't been that great to give a push apart from a couple of names like L&T maybe? So apart from that, do you believe that there's any red flag that the investors must be missing out on, probably the time to book profits in some pockets, which you have been highlighting that the stock specific movement they should be tracking per se when it comes to small cap?
So one, I think as far as impact of US Fed moves on markets globally and on Indian markets is concerned, I think probably in all probability today there'll be another 25 basis points rate hike by US Fed. But having said that, I think that's already priced in into equity as an asset class globally as well as in India. So I don't see that having any negative rub off on equities in any ways. Having said that, as I said, see, to put things in context, a lot of these small cap companies are now operating near full capacity, which effectively means the operating leverage in their system has been completely exhausted or significantly exhausted. And now from here on, these companies will have to start investing into creating new capacities, or they will have to get into investment phase. Generally, when small cap companies get into that investment cycle, their return ratios and tends to moderate, and they tend to use their free cash flows back into investments, and as a result of which there's some impact on their operating numbers in the near term. So I would think that there are pockets where we've had very sharp moves in small caps, essentially, as you said, especially in the capital goods sector, where we see in some sectors, especially capital goods, where the underlying growth is strong, including some of the railway names and defense names you said. Some of the small cap companies are trading at valuations which are more expensive than the large cap companies. Now, that is something which is a dichotomy, I think, which cannot sustain over a longer period of time. Similarly, in engineering and capital goods space as well, that there are small cap companies which trade at significant premium from a valuation perspective as compared to the large cap peers. And which is where I feel that it's not a bad idea to take some money out of these small cap companies, because the stocks have done exceedingly well over the last 6 months and last few years. Many of these stocks have become like 10, 20 baggers, and now they are trading at valuation premium to large caps, which certainly is not sustainable on a long-term basis, and probably redeploy that money to large caps where the risk is significantly lower.
Pankaj, but since you have such a rich experience in equities and we have you onto the personal finance show, like you were highlighting one point that maybe the valuation comparison between the small cap and the large cap space is something that you watch out for, and you believe that this is not sustainable in the long run. But other than that, if I may ask you, which are some of the top 5 points that you look into one company, probably in a small cap, before investing in? As a thumb rule, which 5 areas that the company or the financials of the company should justify before you enter?
So, okay, very interesting question. So essentially, one will look at, I think the first thing I would advise investors to look at is look at the balance sheet of the company. You want a company which is not significant, which does not have significant leverage or debt on its balance sheet. You want companies with strong balance sheets, because remember, these are small companies. So, and every 5 years, let's say, there will be some crisis locally or globally, and these companies need to survive economic crisis. And because they are small, they tend to be more vulnerable as compared to large companies. A lot of small companies failed during COVID crisis. So I think the first and foremost thing is to buy a company with rock solid balance sheets with very low leverage or moderate leverage is one, I would say. Secondly, then try to understand have some understanding of the business of the company in terms of its growth prospects. You want that company to be growing. So, for example, let's say if I'm saying for a normal investor, if you walk into a departmental store, you like some product which is manufactured by a small cap company, for example, let's say, I had some investor who bought some cakes which were made by Bector Foods, and it was a small cap consumer company, and he went and bought Bector Foods after seeing the balance sheet of the company. So try to get some understanding of the business of the company, and third thing I would look at is the valuations in terms of what are the earnings of the company and where the stock is trading in terms of P multiples and this thing. Fourth, try to do some due diligence on the reputation of the company, the business, and the promoter, and which can be done through some basic or primary research, I would say. And finally, I would say in small cap companies, look at their dividend track record, because good companies, even if they are small, tend to have a long track record of paying good or healthy dividends to shareholders, which effectively shows that company is shareholder friendly. So from a uh, uh, investor's perspective, probably these are the 4 or 5 things that I would look at before investing into a small cap company.
Thank you so much, Pankaj, for highlighting or jotting down all of those points. I'm sorry, I know that you weren't prepared for this one, but you briefed it up very nicely for all the retail investors probably looking out to invest fresh in small cap companies. But lastly, Pankaj, just wanted to understand, we did touch upon a lot of sectors that may be looking overvalued or not. This is something that investors should know. But at this point in time, any sector that is still looking bullish to you, we know that your preference recently has been in the new age technology companies. But other than that, anything that is looking interesting right now to you?
So we have been underweight traditional IT services for some time, for almost 2 years now. So we've turned positive on IT services because we think the fears of a sharp contraction or recession in US economy have turned out to be not true in that sense, because the US Fed has done such sharp rate hikes over the last 18 months. And yet the US economy is holding very well, and it's been very resilient. And we think we think IT spending will come back with very strongly in the second half of this year and going into next year. So IT services is one space where we have been somewhat cautious over the last few years, but we've turned positive. And second thing we have started liking is auto ancillaries, because the whole auto space was impacted because there was a shortage of chip supplies over the last 2-3 years post-COVID because of the resurgence in demand for automobile vehicles. Now chip supplies have become normalized, so there is an increased production from OEMs across the board, and the auto ancillary companies will be a big beneficiary of that. So auto ancillary and IT services is the two sectors that we have started liking, and we find valuations in both the spaces are very reasonable in that sense.
Pankaj, always great to have you on the channel, and thank you so much for all your time to the Personal Finance Show, the ET Money Show. It was great having you. Thank you so much.
Thank you.
So that was Pankaj Murarka sharing his outlook on what to do in the small cap index. And at this point in time, what space is looking interesting is the IT space as well as the auto ancillary space, which maybe with the points that we try to highlight, that what all you need to look before investing in any small cap company, then you can do your own due diligence and invest in good companies. But with this, viewers, it's time to slip into a short break, but don't go anywhere. We'll be right back with more.